Good day from LearnCity, where we make the complex world of finance simple and understandable. Today, we're looking into the world of technical analysis, specifically focusing on a concept known as swing high. Swing high, a term you may often encounter when delving into the realm of technical analysis, is a pivotal concept to grasp for anyone looking to navigate the financial market. It's a term that is not only vital for understanding market trends, but also for making strategic trading decisions. In the simplest of terms, a swing high is a peak in the price of a security. It occurs when the price of an asset, such as a stock or a cryptocurrency, reaches a higher point than the prices immediately before and after it. Imagine you're climbing a mountain and you reach a point that's higher than the surrounding terrain. That point is akin to a swing high in the financial realm. In essence, a swing high is a candlestick on a chart, where the high of that candle is higher than the high of a certain number of candles to its left and right. It represents a turning point or a peak in price action, indicating that the price of an asset has reached a temporary, if not long-term high, and could potentially be on the verge of a downturn. But how does one trade using swing high, you may wonder? The key lies in identifying these swing highs and using them to predict potential market trends. Traders often use swing highs in conjunction with swing lows, the opposite of swing highs, to identify potential trend reversals and to set stop loss and take profit levels. For instance, in an uptrend, a swing high is often succeeded by a higher swing high, followed by a swing low that's higher than the previous swing low. If this pattern is broken and a swing high is followed by a lower swing high, it could potentially signal a trend reversal from an uptrend to a downtrend. Traders often use this as a signal to sell their positions and potentially profit from the forthcoming downtrend. To bring this concept to life, consider a hypothetical scenario in the stock market. Imagine a stock that has been steadily climbing in price. Each new peak it reaches is a swing high. If the stock reaches a peak that's higher than the previous ones, but is then followed by a peak that's lower than the previous one, it indicates a potential trend reversal. This could be a signal for traders to sell their positions in anticipation of a price drop. In summary, swing high is a fundamental concept in technical analysis that represents a peak in price action. It's a critical tool used by traders to identify potential market trends, make strategic trading decisions, and potentially profit from market volatility. By understanding and effectively using swing highs, traders can navigate the financial market with more confidence and precision. Thank you for joining us on this journey through the peaks and valleys of financial market trends. This has been LearnCity, making finance simpler, one concept at a time. Until next time, keep learning, keep growing, and keep investing wisely.